as long as they're financial. 888-99-CHART is our number, 888-992-4278. Let's go ahead and take our first caller question from Roger in Palo Alto. Hi, Roger.
Hi there. I had a question about the inflation rate. For many years, a long time ago, 4% was considered to be normal.
Yep.
Now they're talking 2%. And
Right.
There's been a change in the way this is calculated because most people don't need much housing, food, or energy, and they've changed the way that's calculated. And what are your views on, is that a factor of 2 or a difference of 2?
Yeah, they changed it a number of years ago to reduce the top-line inflation number, and I just think that was wrong. We still use a lot of energy. I mean, why would you make that less important? Energy and food are the most important things that you and I consume, so that affects us the most. And they keep quoting, they keep quoting inflation. X energy and food, the inflation was this. Well, wait a minute, we can't X it out of our lives. I think that if you see what they when you see 5% inflation reported officially, probably closer to 7%. That's what I think. Because I think that when they recalculated it, I don't agree with it. It's 1,000-item basket that they count, 1,000-item basket. And the way they count it really bothers me because if you had an iPhone that went up in price $200 for a brand new one from a one last year, they will say that's not inflation because it has more features or a computer or a laptop. Or, and it makes no sense. We still have to pay $200 more for it, but they say it's more efficient, therefore there is no inflation in the price. Well, I think that's kind of ridiculous, but that's how they do it. So, no, I don't agree with the official numbers. I think they're always low, to be honest. Roger, thank you very much. We're going to go to Paul in San Francisco. Wants to talk about Social Security. Hi, Paul.
Yes, I'm Paul. I've heard over the radio that Social Security payments are taxed at the highest rate of 85% of a person's income, but at what level of income does that become 85%?
No, it's not taxed at 85%, but 85% of your Social Security benefit is taxed. Okay?
I know that.
Okay, so it's not like that the rate is more for them. It's that the most of the money of your Social Security benefit will be taxed as income. So whatever income tax bracket you're in is what you will pay on most of your Social Security, generally speaking. Unless that's all you're getting and you're getting very little and you're in a poverty level, then yeah, your tax rate will be very, very low. Okay? So it's not an 85% tax rate. It's 85% of your benefits will be taxed at your ordinary income rate for that year, whatever that rate is. So if you're making a lot of money and, in any way you're still working or you're got a huge pension plan, then you're collecting Social Security, well, much of that money is going to be taxed. Thanks for the call, Paul. Appreciate it.
Do you have questions about FDIC security, mortgages, money market funds, losses to your retirement plans? Give us a call today, 888-99-CHART.
Hey guys, James from Washington State. Just had a quick question for you. Wondering if we should be investing in other exchanges and how exactly we would go about doing that. So obviously I'm invested in a bunch of international companies or international stocks through the New York Stock Exchange or the exchanges we have available here in the U.S. For diversification purposes, are there others outside of the U.S., other exchanges that we should be looking at trading stocks on? Appreciate any information or any thoughts you may have on it. Thanks. Bye.
Well, investing abroad is not a bad thing, especially now that the dollar is in a downtrend and likely due to our debt situation and our demographic situation. It's going to be increasingly difficult for the Fed to raise rates, to become super hawkish. So they're going to longer term have to err on the side of dovishness, which means probably a weaker dollar. Now, that would be beneficial for companies that are listed abroad. Some are dually listed here in the U.S., some through an ADR, and that's a good way to get exposure. Well, there's nothing wrong with buying companies and other exchanges as well. But you have to keep an eye on the geopolitical concerns and the currency risk. Now, you don't just say, oh, I'm going to buy a company on another exchange on a whim just because it is listed abroad. You have to have sound investment reasons to buy it. But there are a lot of great values overseas, especially in relation to what you're seeing here on domestic exchanges. So yes, the answer simply is yes, you should be looking at other opportunities abroad. Doesn't mean you buy them necessarily, but you're going to get a different subset of opportunities and probably a higher percentage that are good values compared to our domestic market. Hope that helps. And remember, if you're buying a stock on another exchange, there are some trading costs there that you have to keep an eye on. So talk to your broker about that.
You can call right now and be part of the program. Let's hear about what your talking point is. 888-99-CHART, 888-992-4278, and you can get through right now.
When listener questions are played on the InvestTalk podcast,
how do you guys determine a value stock?
The caller voices are amplified many thousands of times.
Just wanted to get your opinion on JP Morgan and BAC.
How do you see this looking forward? I'm 25 years old and have a question about retirement funds.
And the unbiased answers from Justin Klein.
That's why it's trading so cheap, because there's a lot of regulatory risk here.
And Steve Peasley.
I kind of like it here. If I was going to buy Tyson Foods, this is where I'd buy it.
Benefit the entire InvestTalk community.
Thank you for what you guys do.
That's why 24/7, rain or shine, no matter how simple or how complex, your questions make a difference.
Symbol BKE. What's your outlook?
And InvestTalk is made better by the power of you. So don't forget to call 888-99-CHART.
You're listening to an encore presentation of InvestTalk. Please call with your questions and comments, though, 888-99-CHART, 888-99-CHART, and Steve will answer them on the next InvestTalk.
I've just got a question about transferring either cash or equities from individual taxable account into a Roth IRA. I'm assuming if I transfer cash, it's just going to be deducted from my $6,000 cap for the year. But I'm wondering what happens if I transfer shares or a whole position. Does it get deducted from my max contribution at the value of it at the time I trade it? Or is there any considerations or things to think about when transferring things over like that? Thank you guys very much. Appreciate all you do. Have a good one.
Good question. This is easy. You can only fund a Roth IRA with cash. Now you can combine IRAs. If you have multiple IRAs, you can combine them all together into one. Now you don't want to commingle Roth and traditional IRA assets unless you're doing a Roth conversion of some type. But you can't do that. I know a lot of people try to get around that or whatever, but you have to use liquid cash into a Roth IRA. Then you can go buy whatever equities you want, etc. But you need to do it with cash. You can't just transfer the equities in. Thanks for the call.
Hi, guys. My question is regarding when you calculate ratios for companies, do you usually use the GAAP or non-GAAP? Because, some of these numbers vary so much. What is your policy when you do your calculations in general? Thank you.
We absolutely 100% do not use non-GAAP. Non-GAAP is something I think should be illegal. I don't think companies should be able to basically make up their own measurement for their earnings. That's what non-GAAP is. It doesn't adhere to generally accepted accounting principles. That's what GAAP is. So the question is, what are their principles? This is something that happens a lot in the tech industry. I remember WeWork they had their own, which was like community adjusted earnings or cash flow or something. Basically stripped out all their expenses So the simple thing, GAAP's there for a reason. So that when you're judging earnings from one company to another, it's based on the same principles. Not based on the principles that some management team made up to make themselves look better, which happens all the time. Now, they'll make excuses like, we're just trying to give you a better view of whatever. But a real analyst, a real investor, is not going to really use PE anyway, right? We don't really use earnings per share that much anyway. I have many other metrics I can use to filter out the noise. From cash from operations, to EBITDA, to EBIT, return on invested capital, return on assets. There's a lot of other metrics to use that give more insight into the business than straight up PE ratios. PE ratios, frankly, they're old and antiquated. And then when you throw in a made up number like non-GAAP, makes them even more useless. So hopefully that gives you a little perspective on our perspective for non-GAAP.
The InvestTalk voice bank never closes.
I have a question for you about Amazon.
So your questions keep coming.
Question about PE ratios.
And that's okay, because Steve Peasley and Justin Klein specialize in unbiased guidance.
If I'm looking at a dividend company, I'm looking for consistency of earnings and dividends.
Your standard daily chart typically goes back 1 year.
Steve and Justin are fearless, so don't forget to call InvestTalk. 888-99-CHART.
Okay, we're going to go talk to Gene in Raleigh, North Carolina, relocating to a retirement spot. Are you there, Gene, or you're still moving?
Oh, no, it's a couple of years away, but I was curious. In the past, you've talked about, in past shows, you've always talked about relocating from a high-cost state to a lower-cost state. And I'm wondering, have you seen any trends in the people you're dealing with, or you've heard the news about people moving out of the country to particular areas for retirement to lower the costs, particularly areas in Mexico or Canada or even other countries?
Yeah. We call those expats. But I have a client, she lives in Oklahoma, which is not a high-cost place. But she likes to go to Mexico in the winter because it's so cold in Oklahoma. So that's what she does. And the cost is really, really low for her to lease a place for like 3 or 4 months, 5 months in Mexico. But there's also people that move completely out of the country and don't plan on coming back. I even talked about earlier this week or late last week about billionaires moving out of the country and getting rid of their U.S. citizenship because of the high taxes. But one of the destinations people like is Panama. Now, I don't think I could take Panama because of the humidity, but you can live right on the water, lots of islands, and pretty reasonably. And people like it because they use U.S. dollar, they speak English, that kind of thing, so it's easy. I also had a client who moved to the Philippines, and he doesn't make much money. He wasn't wealthy, doesn't have a lot of retirement money, so he moved there. He can live very well on his Social Security alone in the Philippines. So, people move.
2 tips. I did hear about the Philippines, and I think in general what I heard is 2 good tips is to understand the entire season of wherever you live, the weather, and also know what type of rules apply to foreigners who own properties.
Yeah, some places won't let you buy property. Some places won't let you in at all. Europe, a lot of places, you can't move to Europe. You just can't drop and say, I'm going to go move to France. You can't do that. They have very strict rules in various countries in Europe.
Thanks a lot.
Yeah, appreciate the call. Thank you. You're listening to InvestTalk, everybody. I'm Steve Peasley. We want to answer your questions. Our listener line number is always ready for you, 888-99-CHART. Beginning our experience, we're here to answer your question.
You're listening to an encore presentation of InvestTalk. Please call with your questions and comments, though, 888-99-CHART, 888-99-CHART, and Steve will answer them on the next InvestTalk.
This is Alan from Hayward, California. Love the show. I learn a lot all the time. When I think of passive investing, I think of set it and forget it. It doesn't matter if it's a red or green day for the share price, you buy it regardless. So when people invest in a cyclical company like ExxonMobil only for the dividend income, should they be concerned about when to buy it, or can they set it and forget it and buy it at whatever price it's at, so long as they're only in it for the dividend income? Should I be concerned about the share price and paper losses of my principal while passively collecting the dividends? Exxon is a dividend aristocrat, which means its dividend is generally considered safe. If not ExxonMobil, are there any individual paying companies that I can passively set it and forget it? Thanks. Love the show.
There are, but ExxonMobil is one of them. They're big blue chip companies. You can buy them and forget about them. But I don't like to buy them after they've had a pretty strong run up. I wait. I wait till the cycle's down. So I bought Exxon and Chevron, a while back when they were much more, attractive. Okay, now at 116, it's gone from like $35 in 2020 to 116. So it's hesitated around 60, which was a good buying opportunity. And now it's 116. I think I'd wait for a pullback. But yeah, the most common things that you could buy and set and forget is index funds. There's a ton of index funds that slice and dice up the market. You could buy those ETFs for those index funds, buy them whenever you want to, and forget it. You could do that. Now, of course, everybody wants to buy low, but and let it ride up. But most people have a hard time buying low because everything is going down and everybody's panicking and the stocks are falling and they don't want to buy. But that's exactly when you should buy. When everybody else is a seller, you should be the buyer. When everybody else, not just some people, I'm talking about an overall market fall like it did last year, you need to be a buyer. Okay, and if you're not and you're a buy and holder, just hold it through the dark times. You'll be fine. You will be just fine.
Thanks for your guys' show. Today I had a question on railroad stocks. I just wanted to get your overall opinion. I've heard people talk about them in a positive way, negative. I'm just looking to see what you guys think about them. I have a few on my screen here: CSX, Canadian National Railway, Canadian Pacific Railway, Norfolk, Southern Corporation, Union Pacific. Just if any of those are good investments or something that I should look into, or if you could just talk about why railroad stocks are bad investment based off of one of those companies. Just something to kind of help direct me on how I should be looking at these, if at all. I'll be looking forward to hearing your answer on the podcast, and thanks as always, guys.
Well, railroad companies are definitely not bad investments. They typically, most of them are very profitable and consistently profitable. They have a monopoly on the routes that they own. And usually there's not a whole lot of cheaper alternatives, especially if oil prices continue to stay relatively high, right? The trucking costs would continue to go up. So I actually like the railroads longer term, but you have to be very specific on which railroads and regions you're talking about, right? So companies like Norfolk, as well as CSX, they're mainly focused on the eastern part of the United States. And I think net, they'd probably be beneficiaries longer term of deglobalization, just because there's still a lot of industrial base that happens in the Midwest and East Coast. But when it comes to companies like Union Pacific, which pretty much dominates the western United States, they benefited dramatically from everybody or all these companies exporting production to China, because they're the ones that were bringing it from the ports in Los Angeles and Long Beach, the two busiest ports in the country, into the center of the country. And so that's what you want to think about first off, is which ones to pick, which ones are going to benefit the most from deglobalization, which ones are going to be hurt the most. But in general, they tend to be good businesses to own. Now, when I speak about all that, that's more medium to long term. The difficult part near term is the ebbing demand for physical goods. Talked about this for a while. Everything's mean reverting back to pre-pandemic levels of consuming services versus physical goods. Obviously, railroads don't move services. So people are buying more services versus goods. Net, that's negative for railroads. So once we get on the other side of this and things fully right the ship when it comes to inventories and consumer demand, etc., you can start thinking about buying those railroads that will benefit from deglobalization. Hope that helped.
You can call right now and be part of the program. Let's hear about what your talking point is. 888-99-CHART, 888-992-4278, and you can get through right now.
You're listening to an encore presentation of InvestTalk. Please call with your questions and comments, though, 888-99-CHART, 888-99-CHART, and Steve will answer them on the next InvestTalk.
We're going to go up to Stockton, California, and talk with Wesley, and we'll talk about asset allocation.
My question is a two-parter. One is asset allocation and a 401k. I know that we're bigger on small caps and maybe internationals. What do you think of a small cap international fund? Thank you.
Well, asset allocation in your 401k, a lot of that depends on your age, your risk tolerance level, etc. Small caps right now, generally across the world, have better value than the larger caps relatively, and foreign stocks also are cheaper in general. Now, part of that is because they should be cheaper because of geopolitical concerns here in the U.S. We're fairly insulated, luckily. We're oceans away from any major geopolitical rival, so that's a good thing. And we have fairly stable political environment. So we should be trading at a premium compared to the rest of the world. But you could argue the premium is too large. So I would say that's generally a good idea. However, a lot depends on what fund in your 401k that is. It could be a very bad fund within that space. But as long as that fund ranks out fairly well, not a bad place to put some allocation of your 401k. Now let's go back to the InvestTalk voice bank at 888-99-CHART.
Hey, Steve and Justin. My name is Eric. I live in southern Indiana. I work a lot, blue-collar guy, but my grandpa always told me to invest in SPY, S-P-Y. So I've been doing that since the mid-'90s. Well, I gradually went from that to VTI, and then with work, I have FSKAX through Fidelity, all broad-based index funds. I'm in my early 40s now. I'm trying to understand if it's worth it to just investigate single stocks, companies. I don't have a lot of time. I could make time, but I'm curious because the SPIVA, S-P-I-V-A, the SPIVA results state that long-term, no one beats the index over 20, 30 years. So I just wanted to see what you think about that. I'm not asking to point out your track record as a company versus the index over 20, 30 years, but just wanted to give your advice. I just stick to the index or put aside 3-4 hours a week investigating companies. Because I can tell you right now, I like Waste Management, I like Costco, I like Dollar General, companies like that. But I know that anything can happen, and the index is safe. Thank you.
Well, I wouldn't say the indexes are safe. Just go look at 2008, right? The S&P fell over 50% from peak to trough. So when you're talking about whether it's an active fund or an index, if you're just talking about equities, equities are not safe. You cannot use those two words in conjunction. Now, are there safer equities than others? Yes. They have less volatility than other equities? Yes. Obviously, large caps typically have lower volatility than small caps. Yes. There are broad generalities, but no equity, all equity portfolio is considered safe. Okay. Now let's talk a bit about the indexes that you're speaking about. And you looked at SPIVA, for example, and you said nobody outperforms the indexes, and clearly that's wrong. Even SPIVA says that. Going back 15 years, now they will say only about 10.5% of large cap funds beat the indexes. Only 10%. But that also means that those large cap funds are charging a fee that's probably higher than what the index funds are. So that's the vast majority of why they underperform. But if you go 10 years, still about 10% outperform. 5 years, up to 15.5% outperform. 3 years, 14%. But 1 year, up to 44% outperformed last year. And so these things go in cycles. Everything has a cycle. Everything. Short, medium, long-term cycles. Typically, active funds versus passive, they outperform based on in various cycles. Okay? For many years in the past, when value outperformed, for example, those active funds tended to outperform. When the S&P or the indexes in general get overweight too much sectors that are too expensive, eventually the tide goes out and that shifts back, right? So there's always those cycles. Now, if you don't have time to go and buy individual names and do the research and have the discipline and the data and the perspectives to make good decisions, you don't want to do a lot of work, the index is fine. I would say you go find a value-based index. You can do it that way. I would argue that's better. Value tends to outperform longer term over growth. And so that's what I would say, is just you could use an index, but a value index, for example. Okay. So trying to say active always underperforms, because it doesn't. Nothing is absolute in the market. Nothing. Nothing's absolute. Nothing's guaranteed. Can't paint everything with a broad brush and say there are no caveats. There are always caveats to the general rule about almost everything in the markets. But those caveats typically have a caveat. They have a reason why they broke the mold. So, and SPIVA, which you're talking about, that's the S&P. They're there to champion indexing because they make money off indexing. It's just the way it is. So always think about these things dynamically and make sure whatever strategy you're deploying is right for you, the time and expertise you have to put into it, your risk tolerance level, and make sure you never think of equities as low risk. They never are.
This is InvestTalk, made possible by KPP Financial, where principals and InvestTalk hosts Steve Peasley and Justin Klein are independent financial advisors. For clients, they are fiduciaries. Steve and Justin have a duty and a commitment to always place the interests of their clients ahead of the firm. This is different from the way many other organizations operate. And one way you can realize the benefit of an association with KPP Financial is to know that KPP practices parallel investing. This means that the personal investment accounts of KPP principals participate with client investments at equal prices and percentages. It's an important difference. You can learn more anytime at investtalk.com or reach out to Steve Peasley and Justin Klein by emailing or calling their Irvine, California office. The InvestTalk radio and podcast continues now. The phone lines are open. Call with questions, 888-99-CHART.
I'm asking about my 401k. It is enrolled in a Vanguard Target Retirement 2030. Now, I've noticed that it has a lot of, like 20% of it's in tech stocks. It looks like it's heavy in the growth. I was wanting to get your opinion of that particular fund, and I have an option of like 24 other ones that I could potentially roll it over. Should I be looking at maybe changing funds? I appreciate your help. Really appreciate the podcast, and enjoying learning from both of you. You're doing a great job. Have a great day.
Okay, so he's in a 401k target dated fund, meaning you pick the date, 2030, 2035, 2040, as to when your retirement date, and the fund itself will adjust itself to become more conservative as you get close to retirement. Now, why I don't like them is hopefully you have other better choices, variety, but why I really don't like them is that they completely ignores interest rates movement. For instance, the Fed right now is raising interest rates, and these funds are the bond funds and conservative funds that these target dated funds move toward as you get closer to the retirement date. They buy bonds. They don't care rising interest rates, falling interest rates. And when interest rates are rising, those bond values go down, so you're losing money on them. Well, you can lose money in the stock market too, but don't think, and when the interest rates start to rise, okay, they go down. When the interest rates start to fall, they go up. So, target date is 2030. That's 7 years from now? I guarantee you interest rates will probably go down and up in that period of time. So and your fund will just become more and more conservative. Anyways, the point is, I don't care for them for that reason and a few other reasons. So I would suggest you look for other funds, in your lineup. Say you had 24 of them. That's quite a bit for a 401k, actually.
Do you have questions about FDIC security, mortgages, money market funds, losses to your retirement plans? Give us a call today, 888-99-CHART.
Okay, let's go to another question from Alberto in San Jose.
Hello, Steve. I love your show. How are you?
I'm good. Thank you for the call.
So I've been dabbing in cryptocurrency, just a little bit less than, or maybe 1% of my portfolio. Right now, I know most of them are down compared to last year, but my question is it better to invest in the platforms Coin or Robinhood rather than invest in individual cryptocurrencies? I mean, all of them trade on those, a lot of them trade on those platforms, so would it be better to buy the stocks for those platforms rather than individual cryptocurrencies?
Well, it would be better to buy a basket of them, but I don't like cryptocurrency at all. I think most of them will go bankrupt. There's only going to be, 5, 10 that survive out of 10,000 cryptocurrencies out there. I'm just not keen on that space because it's like the wild, wild west. I mean, you've probably seen the movements, and everybody falls in love with some of those movements. If I would have bought it here, I would have been up 10,000%. But you also lost 10,000% on some of it too. So it's so wild west, and there's no government backing. There's no rules. It's very, very risky. Now, I'm glad you told me you only have 1%. So if I was going to invest 1%, which I don't have a problem with you taking a risk, Alberto, with 1%, I'd probably do an ETF of cryptocurrencies, a basket of them, which will include probably dominated by the biggest cryptocurrency, the ones that we all know and hear about. So that's probably what I would do. I wouldn't invest in any one crypto, and I don't think the platforms are the place to be. I don't. Alberto, thank you for the call.
Okay.
I appreciate it. Thank you.
Now let's keep things moving and play 2 in a row from our 24/7 listener line, 888-99-CHART.
Hi, Steve and Justin. It's Art from Tucson. Hey, I was wondering what you thought about the Dogs of the Dow investment strategy for 2023. Just to give you the freedom to discuss some of the stocks. 3 of the Dogs of the Dow is usually the top 10 that are down the most in the Dow Industrial Average, as I understand it. I was looking at 3M, MMM, Intel, INTC, and Walgreens, WBA. Those are 3 that are really down significantly. Just wondered what you thought about that theory. It's supposed to give superior gains over a lot of years at least. And I'll listen to your answer on the podcast. Thanks for all you do.
Well, the dogs of the Dow aren't the 10 that are down the most. It's the 10 highest yielding, dividend yielding stocks in the Dow Jones Industrial Average at the beginning of each year. And for this year, 2023, it'd be Verizon. It's about 6.6% yield. Dow Chemical, 5.5. Intel, 5.5. Walgreens Boots, 5.14. 3M, right around 5%. IBM at 4.68. Amgen 3.25, Cisco 3.2, Chevron 3.16, and JP Morgan right around 3%. So those are the dogs of the Dow for this year. Now, is it better than just owning the Dow outright? Yes, numbers play out. However, this is just simply a value strategy. It's really what it is. You're using one simple metric, a decent metric, but only one metric. And some of these companies I would invest in, some of them not so much. And, because it doesn't take into account leverage, quality of their earnings, growth, things like that I think are important. And the numbers say they're important. So is this better than just buying the Dow? Yes. And it's very easy. But that doesn't mean it's the best strategy. It's simply a better strategy than owning the Dow, and that's not saying much. Okay. So, you listed off some stocks. Some of those are good, not so good, like I said. So, you're not getting a lot of diversity, first off. That's a big problem. Only 10 stocks. The numbers say, hey, you need about 20, 25 different names to be properly diversified. Remember, the Dow is 30 names. Dow is the worst. The worst. And this is one of those things that I don't talk about much because I feel like I've talked about it over the years so many times, but I know there's a lot of new investors, newer listeners. But the Dow Jones, even though it's talked about a lot, what did the Dow do? It's the biggest number, right? So if it moves 300 points, that sounds like a lot. Well, in reality, if the S&P moves 50 and the Dow moves 300, the S&P moves a lot more than the Dow, percentage-wise. And it's price cap weighted. It's literally, I don't want to use bad words, but it's literally the worst index ever to even pay attention to. It has no basis in understanding of what the market is doing or has done. But once again, a dogs of the Dow strategy, it's better than average, but it's still not great.
Now, if you have a question about a stock or an IRA, college savings plan, well, maybe buying a house, mortgages, reverse mortgages, we're here for you. 888-99-CHART, 888-992-4278.
You're listening to an encore presentation of InvestTalk. Please call with your questions and comments, though, 888-99-CHART, 888-99-CHART, and Steve will answer them on the next InvestTalk.
Yes, Justin, I have a strategy question. I own stock in a very good company. However, as many others have experienced, I overpaid and the stock has fallen and turned a handsome profit into a loss. Stock's now at or approaching an attractive buy point, although I'm sure it may go lower with the market. My question is, should I sell the stock for a tax loss, wait 30 days, and then see if it is attractive to repurchase it, or hold the stock, buy more as it becomes attractive, and hold for the long term, anticipating a profit over that long term? Appreciate your thoughts on this, and great show. Thanks a lot. My name is Dick. Thank you. Bye.
I'd probably take the loss, as long as it's in a taxable account, then that's obviously you can apply the loss to gain, future gains, and wait the 31 days and buy it back because we had a great January, really. Market up about 10%. So this would be the time to take a little profit and see if the market falls down. You can buy back 31 days. I mean, I probably would take the loss, and then if I really still like the stock, buy back. Now, the risk you have is the stock could continue moving up, and then you just got out of a stock that you could have made money on. But, we're still in a pretty difficult stock market environment. So I'm thinking January was a really good month, and that we'll have months that are going to be pulling back, and that might be better strategy. Okay? Just what I think. Okay? That's what I do.
Hey, Stephen, Justin, this is Shaz from Virginia, a long-time listener of the podcast here. I had a question about investing in 529 plans. I was researching a lot of 529 plans across different states, and I was wondering if I start now from a time horizon of 18 years or so. I just had a baby, so, I have a long time horizon. Does it make sense to just start dollar cost averaging in an index fund, go find the cheapest available in any other states, and just start BCA in that? Is 18 years long enough time frame to do that, or be some other kind of strategy that I should be looking into? I know long term you want to stay in the market, and for my retirement accounts, I just put it in index funds and I forget about it because I have 30, 40 years before I retire. But what about 18 years? Is that long enough? I'd be waiting to hear the response in upcoming podcasts. Thank you very much.
The simple answer is yes. Okay, 18 years is long enough to benefit from an index fund. Why? Because historically, there's never been, maybe there's been one or two, but there's very rarely do you have a 10-year period where the market is not up. It's always up. The average return is 9%, maybe a little higher if you factor in dividends. I'm not sure, but 9% a year, that is. So, in that 18 years, you should do well. And when you get close to the end period of that, then you're going to have to, and when I say close, within 3 to 4 years, within the end period, like at the 15th year or so, start being a little more cautious simply because the market might have spiked over the last year or two before that, and then it's going to fall just as you're going to need the money. So, and remember, you don't need all the money right the first year. If the child's going to go for 4 years college, you'll spread that out over time. So you'll have more time to have the investment work for you. So I say yes.
Hello, this is Tori from Bozeman, Montana. I'm calling to ask about a refinance that I'm currently in the middle of. So I'm refinancing a rental property that I own. And I was wondering, because I do have a good bit of equity in that property, and I haven't quite been maximizing my Roth contribution every year. So would it be smart to take some of that equity out of my house and actually just put it into my Roth IRA, where I feel like it can make better returns and possibly beat what my home might be able to bring in terms of equity in the future? Look forward to hearing your answer. Thanks so much. Bye.
Well, normally I would say no. Don't take the equity out of your house, but just contribute new money to the Roth. But with interest rates so very low, you can borrow money against the house you live in at 2.5% or so. That might be smart to borrow the money. Remember, it's always the best use of the money. What's the best use? I can make more than 2.5% pretty confidently in the market, conservatively investing. So would it be? And I still get the 2.5% plus write-off, mortgage write-off. Now you were talking about a rental property. I would borrow against your own personal property if you have equity in there, because